All right, Daniel, what are we talking about today?
What it takes to do it yourself financial planning, tax prep versus tax planning, and reverse mortgages.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, well, if we're going to start with doing it yourself, why don't you do it yourself? What do you want to talk about in this domain?
Today, I want to focus on do-it-yourselfers or DIY. We often see people fall into this level of management because either one, they want to do their finances themselves and are interested in it, or simply because they don't know who to turn to and it's the default remaining and they simply have no other option. But do it yourselfers operate on a pretty wide spectrum from those that are doing everything well and optimizing their finances to the other end of the spectrum, the quote unquote do it yourselfers who are frankly picking a couple of investments in stocks and maybe just saving. So, if someone is going to do their own financial plan and has interest in it, how does a do it yourselfer do it the right way?
I think first and foremost, it helps to recognize kind of how big or small that group is. So, the most recent data I've seen on it, about 39% of people are engaging with some sort of financial professional. It doesn't necessarily mean that they're a fee only financial planner or they're doing comprehensive financial planning, but about 39% of people rely on a financial advisor in some way, shape, or form and find that they get good value for that. Another 22% of people say they would work with a professional if they thought they could afford it or if they had more money. And so then that really just leaves a little bit bigger than one third of the population that doesn't work with a planner and doesn't necessarily think that there's value or that it's worth doing. In terms of how you start as a do it yourselfer, frankly, I think the biggest thing to just start with is a really honest conversation. Do you actually have any idea what you're doing? And I like to make that sort of suggestion because the common experience we run into with our clients or people who want to become our clients is many of them have done finance okay. They've saved, they've invested, they've gotten their financial house in decent order. And the analogy I often like to use here is that they are swimming without drowning, but swimming without drowning is not the same thing as being competitive. So I think first and foremost, anybody who's going down a dedicated DIY path, less so out of necessity and more so out of determination, does need to make a pretty honest self-evaluation about not only what do they know about finances, but where and how have they gained their knowledge. Did they take classes? Have they read a lot of books, etc.? Or are they just sort of hopping on a financial bandwagon from an influencer or something they've seen online and just doing whatever they tell them to?
Right. And that being said, Dan, what are the real things that they should know? I think a lot of people think immediately investing and making sure you're picking the right stocks and investments for your portfolio. Is that all that DIY financial planning entails, or is there more that people should educate themselves on?
There's definitely more people should educate themselves on. Investments tends to be the most common place that a lot of DIYers start, and that largely comes from the fact that investing is sort of the sexy part of finance, right? It's the place where you make money, and so it's always exciting, and it's in the news, and you hope that you bought the right stock at the right time, or you also just have a potentially positive feedback loop, right? If you make the right investments, then you see the numbers go up, and that gets you interested in it. I think from a standpoint of where you should actually be starting is understanding what your income is, what your expenses are. And when I say that, I don't mean that you should start with a budget. What I mean is a lot of people do not have a good handle on their income, on their finances. It's sort of a shocking revelation to realize that there's a ton of people who live paycheck to paycheck, not because they don't make enough money or because they couldn't save or something, but because they're very passive in their understanding of their finances. So they start a job, they set up direct deposit, and that is the last thought they give to sort of where their money is and what it's doing for them. And so we see a lot of good and bad byproducts of that. We see people who are very cash rich, where they have a huge checking account because they don't spend all of their money. So then they are building wealth through just sort of unintended savings, except it's the least optimal place for them to do it. And vice versa, there are people who essentially are spending themselves into a hole. And again, I don't mean this as a you've got to get a handle on your budget. I just mean from a standpoint of there are people who quite literally do not even know how much money they have at any given time. And that might sound silly to somebody listening, but I cannot begin to count the number of times that we will ask something as simple as, how much do we think we have in savings, or what does your emergency fund look like? And the people we're talking to have no idea. So first things first, get an understanding of your cash position, your cash flows, and understand, am I accumulating, am I decumulating, or am I just treading water?
Excellent. So going off of that a little bit, there are certain people who are going to be more inclined to do it themselves versus others who never want to do it and are completely happy deferring to somebody who knows what they're doing and having them manage everything for them. Is there a certain type of person, whether analytical, expressive, introverted, extroverted, that you think DIY tends to favor, and a certain type of person maybe that will never really go that route?
I don't think there's anybody that it favors intrinsically from a psychosocial standpoint. So I don't think it's about being introverted or extroverted or even being smart or less educated or anything in between. I think DIY works for people with very non-complex situations, and I'm going to define that more financially than anything else. I think a person with a non-complex financial situation is an employee. They have a strong set of employer benefits, but also very simple ones. They have something like a 401k, health insurance, vision, dental, that sort of stuff, but they don't have things like stock options or equity comp or anything in that nature. And they may own their home, they may not own their home, but whatever real estate situation they have is very singular, right? It's just their property. They don't have a lot of rental properties. They don't have condos, vacation homes, anything like that, and they don't have an entrepreneurial standpoint or situation. And fundamentally, their financial picture from a planning standpoint is income, expenses, risk management, which we haven't touched on, a healthy bit of savings into some preset retirement vehicles through their work, and they're meeting their needs comfortably otherwise. That's somebody who I think is a good profile for a DIY approach, because their margin of error is fairly well restricted to the investments that they select and their savings rate. And otherwise, any mistakes they might make are likely going to be the byproduct of maybe being underinsured. They don't have enough home and auto insurance or something like that, or a career change or something that's largely out of their control. Somebody who owns their own business, somebody who has a high earning professional with complex ownership or assets, somebody with multiple pieces of real estate, or somebody dealing with things like trusts, that is a place where I think being a DIYer is a huge trap. And I say that because, teaching a retirement planning class at the top business school in the state, by the end of that class, I would say the students, even the ones who got, B plus, A minus, A, I would call them barely competent in that subject. And that is a class that they've taken full time. And again, these are bright kids putting in a ton of time and energy into that class. And so the idea that you're going to just sort of waffle your way through complex retirement savings or financial analysis needs or personal finance needs largely on some Googling is sort of laughable at a certain point. There's just too much going on, and it is a full-time occupation to understand all the moving pieces and how they integrate with each other.
Makes a ton of sense to me. Increased complexity typically requires outsourcing to somebody with a little bit more specialized knowledge. As they say, more money, more problems. So definitely makes sense. One more final piece I wanted to touch on was the risk management aspect you briefly mentioned there. The cost of doing something wrong and down the line having to course correct can sometimes be more expensive than doing something right in the first place. Can you talk about that risk management piece a little bit more?
Sure. So, first and foremost, when it comes to sort of the whole spread of insurance, it's pretty rare that we talk to anybody who is adequately insured on all fronts. So, for somebody who wants to be a DIYer, or for a listener who wants to understand kind of the immediate tire kicking I'm going to do for a financial planning client, so they can potentially look at their own situation and say, hey, do I have any of these sort of obvious omissions? I'll just sort of go down the line here. When it comes to homeowners, the immediate things I'm looking for are adequate insurance on the property itself, itself, the amount of deductibles, and particularly here in Colorado, I'm looking for wind and hail damage as a particular exclusion or inclusion on how that is defined. From all of that, my fundamental question is just, hey, if something happened catastrophically to your home, are you actually protected? And then secondarily, if something happened to someone else on your property, are you adequately insured there? Typically, we're going to see coverages of about $300,000 on a homeowner's liability policy, and that's pretty typical. But every once in a while, you see that somebody is sort of skimped here or there, or most critically, back to the wind and hail element, a lot of policies here in Colorado today are starting to get sort of creative with their definition of how roofs are protected or how much coverage there is, and that can be a $20,000, $30,000 mistake on somebody's part, particularly if they live in an older property with an older roof. When I look at auto policies, the biggest thing I'm looking for is what we would call a 100, 300, or a 250, 500. And what I'm talking about there specifically is liability coverages on auto policies in Colorado. Most often what I'm going to see is $100,000 of coverage per person per piece of property damaged and a $300,000 aggregate limit. I'd like to see that be at 250, 500, so $250,000 per person per piece of property with a $500,000 limit. And on top of that, I'd also like to see a $1 million umbrella, which is sitting behind the home and auto policies, so that fundamentally their homeowners policy is really covering them for 1.3 million and their auto policies are covering them for 1.5 million. Otherwise here, I'm also looking at, are we paying for comprehensive and collision on a beater, right? If I've got a 15-year-old car, do I need to pay an extra $400 every 6 months to repair or replace my car when my car is worth less than $1,000? How much money am I wasting by having that type of coverage? And then additionally, uninsured, underinsured motorist. A ton of people do drive without insurance, and so that is insurance that protects you from other people. That tends to be also much cheaper. And then medical payments to others, which is just going to be able to sort of help pay for the ambulance or any immediate hospitalization or issues that arise. Those are the biggest things I'm looking for in an auto policy in tandem with kind of a homeowner's policy and an umbrella. When it comes to life insurance, weirdly, I tend to see either way too much life insurance or not nearly enough life insurance. I don't tend to see a lot of people who are sort of in the right spot here. So way too much life insurance is typically going to be a single person or an unmarried person or a person without children or dependent family members who has at some point purchased something like whole life policy or a universal life policy. And that's usually been done not with insurance as the thing in mind, but like a wealth building mechanism in place. Succinctly here, the question is, what are you insuring for? If nobody's dependent on your income or your assets, why do we have this insurance in the first place? In the case where people don't have enough, typically this is a married couple, often with children under the age of 10. And what I'll typically see here is that they have maybe 1 times their salary through work a piece if they're both working. So maybe, $200,000 here and $80,000 there. But realistically, we probably need something like $1 to $2 million in a situation like that per parent. And it's not going to be equal per parent. It's going to be based on the potential loss of earnings from either parent. Or just even in married couples, often couples have what I like to call 150% of a lifestyle of what either one of them would otherwise afford on their own. So it's not that getting married doubles your costs. You now share a lot of costs like your heating, your cooling, your water, and so on, where you're able to kind of split those costs. But then if one of you passes away, the trick there is that your costs don't get cut in half. You are likely overextended. So then even if you just have a partner, protecting them from the loss of your income if something happens to you is important. And then by extension, disability insurance. A ton of employers are very generous in this area. They'll offer something like 60% disability insurance. But the two big things I'm going to see as a problem here, number one, often employers are generously paying for it, but that then means that the benefit is going to be taxable when you receive it. So you're not going to get 60% of your income. You're going to get 60% minus taxes, which is probably not enough for you to live on. And then the second piece that's going to be here is they often will be pretty skimpy in their definitions. So they will be total disability, not own occupation, meaning that you have to be completely incapable of working, not just incapable of doing the job you had when you became disabled. And they will also often omit a cost of living rider. So it's 60% of your income minus taxes at the time of your disability. And if you're, let's say, 25, that might mean you are going to have very little income for the next 40 years and less and less and less over time just because of inflation.
That's great. Thank you. I think the risk management is oftentimes seen as the most unsexy piece of the financial planning. And because of that, we never really find a lot of folks who come in with adequate insurance. So I want to transition a little bit out of DIY into a different topic. So Tax planning and tax preparation are both very useful services for individuals, businesses, and families. And understanding the difference is extremely crucial because there are a lot of individuals out there receiving tax prep who might think they have long term tax planning and vice versa as well. So, first and foremost, can you just introduce what both services are and the differences between them?
Sure. Tax planning is going to be the act of assessing all of your financial facets and understanding where you are likely to end up in your tax situation without any real changes happening, and then assessing what changes are possible, whether it's how much you save, how much you contribute, breaking up your transactions into different forms, timing certain transactions, all the various activities that could potentially improve your net of tax outcome. Fundamentally meaning we're reducing taxes not only in the immediate sense, but also potentially over a lifetime. Tax preparation is the act of reporting that which has occurred in a preceding tax year. So it's what's happening from essentially January through April, and for many tax professionals, all the way out until October of the year following a tax year, to ensure compliant reporting and that we are, recording all of our activity accurately for tax purposes.
Okay, so feel free to push back on this. You would say tax preparation is more reactive, looking at maybe the last year or last few quarters for tax planning, and then proactive long term tax planning is more looking ahead to years that are going to follow.
I think that's pretty accurate. I think the other thing to contemplate here is many people will confuse having a tax preparer for having a tax planner. And I don't say that to throw any shade at tax preparers. What I mean by that is most people are not paying their tax preparer to do tax planning, and it's not part of the scope of their relationship. So many people think that hiring a CPA or an EA or a uncredentialed tax preparer means that they're doing tax planning. But the simple fact of the matter is most people are not paying nearly enough for those professionals to provide that service. And consequently, while they might have a better tax reporting outcome by working with a professional on the tax preparation and the tax submission, the consequence is they are often just getting the help of a professional to define what they've already done as sort of aggressively as possible, but there's no proactive activity there. They can't undo what's already happened, or they can't make something happen that hasn't already happened. Conversely, those same professionals might be excellent tax planners. It's just going to be an additional service or an extra cost service, but that's going to be the act of doing things within a particular time frame, like the current tax year, or over a series of tax years to have a more optimal tax outcome long term. And so I think it's really critical to recognize that many people should work with tax professionals to get their taxes prepared and have a tax return submitted, but they should also recognize that there's a substantial difference in the time and energy and skill set to just prepare a return versus do tax planning. And many people are not willing or not able to pay what it costs to get high quality tax planning done.
Right. And if you can do and want to do your taxes, your tax return yourself, all the power to you. But you can also completely outsource that to a professional. But for tax planning, is that something everybody needs?
Well, I'll even take a step back on what you just said here, that you can outsource your preparation to a professional. I want to call out two keen distinctions here. First and foremost, the number of tax professionals is decreasing relative to the amount of demand that's out there today. So even basic tax preparation by a competent professional is starting to become a bit of a luxury good. You can still go to certain sort of high volume shops, but I like to invoke Hearn's Law here. You will pay for what you get, and if you're lucky, you'll get what you pay for. So in that sense, even going to a quote unquote cheap tax preparer doesn't necessarily mean that your taxes are being done correctly. The second thing that comes along with this, and I see this quite often for people who have been doing their own sort of TurboTax tax returns, is they'll kind of complain the first year they hire a professional to say, well, I've always gotten a tax return and now suddenly I owe taxes and that doesn't make any sense to me. And they'll sort of blame the preparer for that. They'll say, well, they're not doing a very good job because now I owe taxes. No, probably what's happened is you've been doing your taxes incorrectly in the past, right? You've been claiming deductions you weren't entitled to. You've not been reporting your income correctly, and so on. And so you've been getting fraudulent tax returns or tax refunds, whereas the tax professional is making you report things accurately. And surprise, surprise, if you've been doing well enough to work with a tax preparer who's highly competent and therefore be able to afford their fee, chances are you're in a financial position where not a lot of money is coming your way as a result of the tax returning process.
Right. Okay. So definitely both useful services, but maybe with increased complexity, tax planning becomes more of a concern or requirement for businesses and families.
Correct. And I think in that particular sense, tax planning, and to answer your actual question, is something that many people would benefit from. There is certainly a threshold at which you could benefit from it, but the cost to receive it is too high. So I think, for example, a qualified, highly competent tax planner is probably not charging anything less than $1,000 a year. And frankly, their services will probably be bundled in with your tax return or tax preparation, or with financial planning services, or some other service, wherein your total cost is likely going to be in the thousands of dollars. So if you are, just to give you the example, a school teacher in St. Vrain Valley School District, and you're making $60,000, you're renting your home, you're unmarried, your retirement savings is all flowing through the para pension system, you're probably at an income and complexity level where, unless you're dealing with something like an inheritance or a rental property or some other weird asset, you probably could save money through tax planning, but probably not enough money to warrant the cost of paying a professional for it. I think that's a good case where we circle around to the DIY space and say, hey, doing a little bit of reading on how you can save money on taxes, or some basic strategies you can take advantage of, is beneficial for you. But you are in a situation where fundamentally, the cost of high quality tax planning probably doesn't make sense until your income is in excess of at least six figures, or your net worth is at least measured in the six figures. And I think the value from there only grows with time and with assets and income and so on. But there is definitely a balancing act between the cost of tax planning by a professional and the benefits of tax planning.
Excellent. Thank you. So, final transition here, Dan. I want to talk about reverse mortgages a little bit. So, as we know, many families in the US naturally are going to have a good amount, if not the majority, of their net worth tied into their primary residence and the equity they've built up throughout years in that. And, unless you sell that home and invest the proceeds, a lot of people don't really tap into that equity. And there's a lot of good and there's a lot of bad out there in regards to reverse mortgages. And as you know, with any product with an adjective in front of it, such as leverage, structured, reversed, we approach it with a certain level of trepidation. So I wanted to take a few minutes to talk about reverse mortgages. First and foremost, what are they?
So, reverse mortgages essentially come in two flavors. One is going to be a classic reverse mortgage, which the simplest way to think of it is you've paid off your home, and now we're going to flip the script, and a bank is going to start paying you money as a loan, as a form of loan against the value of your home. So, we've made all these mortgage payments over our lifetime and career, and now we're going to get a stream of income from the value of our home. So we're getting equity paid out of our home. A other alternative version is what's called a HECM. And this particular version is more like a home equity line of credit or a HELOC, in which you have access to the value of your home and you can borrow against it periodically or whenever you feel a particular need, in order to satisfy any cash shortfalls that you might have at a particular time. And in both cases, these loans are collateralized by the value of your home. So long as you live in that property as a primary residence, you are effectively not required to pay back those loans. You can pay them back. You're not forbidden from doing so. But the general benefit here is that you're going to be able to extract the equity value from your property during your lifetime, and not simply have potentially hundreds of thousands or millions of dollars locked up within the value of your home, given that it is, as you mentioned, one of the most valuable assets you're likely to own.
Okay. So loan has to be repaid, but like other loans, when you receive it, it's not taxable, correct?
And that's where we sort of get into a misnomer, which is people will say reverse mortgages are tax-free income. It is not income, not in the technical and tax sense. It is a loan. So in the same sense that spending money on your credit card is a loan, and you don't pay taxes on that loan anytime you swipe your credit card, borrowing money against the equity of your property is simply accepting a liability on the value of your property in return for cash. And so you don't show any income from that, and that's the nice part of it. But it is a loan, it is a liability. You are building a debt to a financial company in return for that stream of income. So at the time that you either sell the property or pass away and your family is now inheriting the property, there is going to be a requirement to repay that loan, either by selling the property or by refinancing into a traditional mortgage.
Okay, great. So reverse mortgages allow for a lot of people to tap into that equity that otherwise they might not tap into. And the loan you receive can be tax free, so there's benefits on that as well. So, Dan, to me, it sounds like you can have your cake and eat it too. But since I've been working here long enough, I know that isn't the case. So, when do these reverse mortgages turn sour?
I think they turn sour when people are not in what they would consider to be their forever home. So, a couple of critical elements to this. Number one, is this a home you can age in place in? So, if you live in a multi 2, 3 story property in your bedrooms on the top floor, etc., in your 50s, 60s, and 70s, that might be just as accessible as it was in your 20s and 30s. But if we get older, through no fault of our own, some warranties might start to expire in terms of our health, our joints, our mobility. And so if you live in a property that is not very accessible to you, particularly with mobility limitations in mind, then you may not be able to stay in your home forever. And that might be something that forces a sale and then sort of causes you to lose that cake and eat it too experience. Other events that can occur is that we don't have the money for long-term care. And so we are forced to enter into a long-term care facility or engage in Medicaid paid for long-term care. And in those circumstances, we once again are going to be forced to sell the home or relocate out of the home. So realistically, a major consideration is that it does need to be your forever home. And then the other piece is, does the home have any particular significance to you? Is this the house that you inherited from your parents, that you raised your kids in, that you want your kids to inherit and have their grandkids in, and so on and so forth? Those factors really do matter because fundamentally, I think a big question that arises from an inheritance standpoint is, what are the kids likely to do with this property? If your kids are likely to retain it, they're going to want to move in, they're going to want to keep it in the family, and so on and so forth, then a reverse mortgage or an HECM is going to be a bad strategy for you, because you're going to place this substantial financial encumbrance on the property that may make it hard for them to afford to own at the time that you either pass away or it passes on to them. Conversely, if this is just a house you bought after you retired and you moved to Florida or something like that, and your family has no attachment to it whatsoever, then the reverse mortgage makes a lot of sense for you, because if it's intended to be your forever home, then you're allowed to enjoy more of that wealth, more of the value you've built up during your lifetime. And when your kids, eventually inherit it from you, potentially, then it'll be encumbered and they'll have to either refinance it if they want to keep it. But chances are they were probably just going to sell it anyway. And in that particular circumstance, yes, you've reduced the potential value of their inheritance from the home standpoint, but frankly, houses are not a particularly good asset to inherit for a number of both tax and kind of transactional cost reasons. So from that standpoint, leaving behind very little equity in the house, but leaving behind a bigger Roth IRA or something like that might be a much better outcome for them, just in a net of tax and convenience of inheritance standpoint.
All right, so to summarize, a reverse mortgage is not for you if you are in retirement and would like to potentially relocate, may want to leave assets to the next generation, and might even want to keep the family house within the family.
All correct.
Okay, great. So can anybody take out a reverse mortgage loan?
You do have to be over the age of 62, so you can't just pull one out in your 20s or something like that. It is tied to your personal life or your lifetime, so consideration also of your spouse's age and their health and your relative difference in your ages is also an important element regarding whether you're going to take out the reverse mortgage on just your life versus your joint lives versus your spouse's life, and the potential ramifications of that. Just because if somebody dies sort of in an unexpected order or time, that can cause some complications. And then functionally, there is a question here about how much equity there is in the property. If you were sort of a late bloomer in owning your property, and so you bought your home when you were 55, and now you're 62, and you're only 7 years into a 30-year mortgage, a reverse mortgage could be available to you in that scenario. But chances are, if there is any value you can get out of that strategy, it's going to be very nominal. And in that circumstance, it may not be appropriate to take it out, simply because the return versus the costs and the obligations of doing it is not significant enough to warrant it.
Great. And what happens if, I have this reverse mortgage and I take the equity out, but I have second thoughts and I want to sell the house?
Well, I mean, you've borrowed money against it, and you are going to owe that back. Now, the good news is your loan is collateralized by the value of the home, so they can't ask you for any more money than the value of the home in the sales transaction. But in a scenario where, let's say, you took out a reverse mortgage very early in retirement, and you've had it for a very long time, and your home has not appreciated significantly in value during that time, there is a scenario in which you might sell your home and essentially walk away with nothing. But again, you didn't walk away with nothing in a lifetime sense. You've simply been spending your return on that sale over the last 5, 10, 15, 20, 30 years, however long you've had that reverse mortgage in place.
Okay. So reverse mortgages, there's a lot of good, there's a lot of bad. For some people who might want to stay in the house, might not want to leave assets to the heirs and tap into that equity, it sounds like it could be a great opportunity. But kind of like you mentioned, it's not a have your cake and eat it too situation, and there are trade-offs that we should all consider if this is an option that we're going to look into. So thanks, Dan.
Sure. I think you summarized it well. There are no free steak dinners. So I'm going to turn it around to you, Daniel. It's been 2 weeks since you've been on the podcast. What have you learned in the last 2 weeks that you think is valuable to share with our audience?
I think it's actually something you briefly touched on earlier, and it's just going back to the insurance. I think it's not fun, it's boring, but it's become a pretty frequent occurrence for clients or potential clients to come in, and it typically is the most glaring issue I think we see in their plans is just either a lack or abundance of insurance, and typically a lack of understanding about how it works, the benefits they're actually receiving, and what they're really paying for. And I think that's just an area that a lot of us, we kind of push off because it's not super interesting and it's not where we're going to see the giant return on our investment. And more often than not, frankly, it's something we don't want to use. And I think just raising more awareness and understanding about insurance and the importance of it, even given how unsexy it is something that I've really internalized over my first 2 weeks.
Sure. Well, nobody wants to be insurance poor, but at the same time, no one has wished you better health than your insurance company. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.